Welcome to the daily update, where I'll go over the action in the market for Wednesday, November 5th, and we'll see how things look for Thursday, November 6th. All right, had a bit of a bounce, a little bit of a recovery. The mega caps held up fairly well. Growth and value were pretty much the same. We're not seeing much of an improvement there. And we're seeing a market that's still not trending and turning a bit more defensive, even though we saw a bit of a bounce on Wednesday. Now, we did give up a lot of the gains. We were seeing a pretty good move earlier in the day, but then late day selling came in and erased a lot of the gains that had been happening. All right, before I get into the video, I have a thing called the SPX investing program. It's free until the end of 2025. Right here is the link that will take you to that. It's hosted on Substack, and you do have to provide payment information to get access to everything, but you're not charged anything. There's also another link below this video where you don't have to provide any kind of payment information, but you don't have access to everything that I post. So feel free to check that out and see if it's something that is beneficial to you. All right, so right at the open, we had pretty much a flat open. Futures were gyrating around. We were positive, and then we drifted back and so forth, but ended up being pretty much flat to slightly lower. And then we climbed above the unchanged level. So actually went down a little bit at the open. The daily pivot, we got above that at 67.86. We climbed above R1. We got above 6,800 and R1 was at 68.06. Then we hit resistance at another round number, 68.25. Then we just chopped along the 68.25 level for a while. We didn't see an awful lot of continued buying, nor did we see an awful lot of selling. We just chopped above and below that. Then it was later in the day. We saw some selling that took prices down below 6,800 and R1 at the close. So we ended up being up just 0.37% on above average volume. Now we're still positive on all three time frames. We're holding out above the 20 period moving averages. Now, yesterday we were using the exponential moving average as support. We broke a little bit below that, but by the time we closed, and even with the bounce that we saw in Wednesday's action, we're still above both the exponential and simple 20 period moving averages. So we're positive in the short term, intermediate, and long term. And interest rates just kind of going back up. We're keeping an eye on that. We're also seeing a little bit of strength in the dollar, which I have an additional chart to show you later on, and that could put some pressure on stocks. What helped stocks come up out of the lows last spring was the dollar going down. Now, the dollar was going down and stocks were going down. Everything was falling apart at that time. About the only thing going up at that time was gold, and then it went into a range there for a number of months. And so when we finally bottomed and the smart money started coming back in, back in and buying last spring, that gave us a nice little bounce up, and then we shifted back and looking more positive, setting new recent all-time highs and so forth. And lots of things going on in the world. There's all the elections that happen in the US, whether you like that or don't like that. It will not necessarily have an impact on the stock market, but it could have an impact on sentiment and how people are feeling. Okay, and then some comments. Mega caps, small caps, and mid caps did outperform. And they gave up a lot of their gains as well, at least a lot of the stocks that we follow. But they still ended up holding on to some gains at the same time. And the broader market did show some improvement, but other areas are still starting to look a little more defensive. And as I said, the 20 period exponential moving average, and you could also include the simple moving average, even though we haven't really dealt with that yet, they are acting as supports currently. So we want to watch those levels going forward to see, do we break through it on an intraday basis? And then how about on a closing basis? We still have a confirmed Hindenburg-Ullman, not a new spike in the latest chart, but it has been confirmed. And the more of these clusters or spikes that we see, the more we should probably respect that and pay attention to it. We still have the Stochk RSI looking extreme negative. That's the only indicator right now that's showing any negative momentum. We don't have a long list here. We're not seeing a lot of conviction currently. And there's nothing Even the stochastics now have fallen off the list as well. Nothing in the intermediate term, no change to the overall scenario. What's really causing some concern for over the last week in the markets is that the rate cut that looked like a done deal is now not looking like it could be a done deal. And with the economic reports that we did get on Wednesday, it's even throwing that a little bit more into doubt now. And I'll go through that in just a moment. The dollar was up, not very much, but it was up, and interest rates were also up. We're climbing now. Just a week ago, we were under 4%. Now we're at 4.16% with the 10-year yield, and ticked up just a notch, but we're still looking extreme negative as far as sentiment, coming in at 24. Whenever we get to 25 or below, that's extreme negative. And this is when we consider using this as a contrarian indicator. But if you remember back to last spring, we camped under 25 for weeks during that whole time. And it's like it didn't really change. And we're not seeing much of a positive setup. We're not seeing anything really oversold right now. The only thing looking extreme negative is sentiment currently. And as far as our trend, we're still leaning more negative now because the red line is still above the green line. We didn't have enough of an up day. Even when we were going up, the red line was still above the green line. I've been watching the ADX closely because I've been implementing and suggesting implementing more market neutral strategies right now. And so we watch the ADX chart when that happens to see is what's changing there. Are we starting to see a new trend? Is it still looking like the ADX is going to drop? It's still below 20. It's still below its moving average, so we're still not in a trending environment. And the bias is mixed now. I could have switched it over to positive, but then we saw that late day selling and some internal weakness. It's still continuing to build and not showing much improvement, so I'm keeping that at mixed. And the momentum is now mixed, a little bit of a switch back, looking a little more positive where it had been negative. Now I'm calling it as mixed to negative. Okay, so we did get the weekly MBA mortgage applications down 1.9%. Last week they were up 7.1%. And this is not a market mover, it's just something that we keep an eye on. It gives us more of a gauge of what's happening more on as close to real time as we can get in the real estate area of the economy. ADP employment change. This was kind of the big one, and this may become bigger since these folks may be coming out with weekly reports instead of just coming out with monthly reports. What we have here is the monthly report, but we're not getting any employment data from the government. So it's like, okay, what do we focus on? Well, let's focus on this. And this actually showed a gain of 42,000 jobs and more than what was expected. They thought it would be a gain of 26,000 jobs. Last time we had this report, it was down 29,000 jobs. And this also is showing growth, but not really boding well for a rate cut. The global U.S. services PMI came in at 54.8. Last time it was at 54.2. Anytime we get a reading above 50, that shows expansion. This is the one that also might rain on the rate cut parade here, coming in at 52.4 with the ISM services. They expected it to come in at 50.9, so that was a lot stronger than expected, which is okay for the economy, but the economy is expanding, and it's like, why are we going to cut rates if the economy is expanding? We don't need to prime the economy at all. This isn't weaker than expected, it's stronger than expected. Or last time it came in right at 50. All right, so here is the ADP employment change. After a couple of months of negative readings here, we finally are getting one that's more positive, which shows that the employment situation is holding up, which may go against the idea of cutting rates. And then here's another breakdown here. It says U.S. added 42,000 jobs in October, driven entirely by large firms, as both medium and small-sized companies shed jobs for the second consecutive month. Gains were concentrated in the services sector. So if you break down this pretty little rainbow here, and really, I just looked mainly at the headline number, but this chart was available, so I wanted to include it. ISM non-manufacturing, or what we call the services, this is coming in above 50, and it did increase where the prices are going up, and that could be somewhat inflationary. You're not going to cut rates if inflation is a problem, so that could be a little bit more negative in the background, according to this report. And then the weekly decline that we saw in the mortgage applications, where it was up pretty strong last week. This week, we're seeing it trailing off. All right, and then we have the buybacks. Now, this is starting to come a bit more into play since the blackout period. Companies can't make buyback announcements when they're going to report earnings. And so that's starting to drift down, as you'll see later on in the video. And so this is coming more to the forefront again. It's the annual change in share buybacks against the S&P 500. You can see there's a really strong correlation. When companies make buyback announcements, that really helps the market. And it's not looking all that strong right now, but it's not looking weak either. And if things continue to go well for the economy and for the market, then you'll probably see this number continue to go up. And then 2025 is unlike any other year as the bears are everywhere. I'm not sure how they draw that from this chart, but it has been a very challenging year. A lot of the short-term strategies that I teach and I implement myself, it's been really frustrating doing that. And because we start to see things moving up or moving down, and we get to the point where it's like, okay, everything's lining up for that to happen. And then the criteria that we use to actually get into a position, that's not met. And because that's not met, that changes the technical picture. And suddenly now we're not looking at any short-term positions. Long-term, everything's great. We're still looking really good, even in the intermediate term, but in the long term, things are still quite positive that way. And this just gives you a breakdown of where we've been up during the year and then how much we were down, at least on this, the difference between the bulls and the bears. It's a real wide spread between the two right now. Okay, risk appetite still leaning above zero here. Folks are still willing to assume some risk. Now, if we do start to see more of a substantial decline, this number is probably going to drop off as people are going to start bailing on some of their positions. Mega cap growth and tech positioning. This is still where most of the action is at right now. The mega caps, tech, the biggest part of the growth area of the market. And so folks want to be in that particular part. And then realized average stock correlation. This is over 3 months. I showed this chart a while ago where we were getting a really low reading, and that sometimes can mark some kind of a bottom in the market. And we have come up a little bit, and there's still more room to run to the upside. Even the scenario that I've been throwing out there right now is even if we do see more of a substantial decline, 5, 8, 10, even 10%, possibly even a little bit more than that. It's at this point, that kind of a pullback would not necessarily ruin the positive bigger picture. Now, it's one thing to say that as a scenario. It's another thing to say, okay, if we get there, then we'll fall back and regroup and say, okay, is the picture still looking positive? Because I have an issue with these folks. They come on the financial media and they're like, okay, we're going to go back and test the November lows or something like that, or the February highs, or they just throw that out there flippantly like it's no big deal. Well, we actually end up doing that, but then the whole technical picture changes and the sentiment changes when that's actually going on, and it's not something that should be treated as lightly. So I don't forecast, I don't predict. All I can say is if we do have a pretty good decline, then it's at this point now, it's not going to change the overall positive picture, but we'll have to reevaluate it if that ends up happening as well. Okay. And then valuation, something we've known now for years, and it's just continuing to go. The stock market is overvalued, which doesn't seem to matter until it does. And that means we can't really use it as a timing mechanism. Then, in case you wanted to know how things are going in China, Chinese equities have outperformed since last year's intervention. All right, okay, if you're into that. And then global median 10-year yield across all sample economies just coming in where we are bouncing back up here with the 10-year yield. And this goes back to the 1700s. So, of course, you remember what interest rates were like back during the American Revolution. And then market implied U.S. recession probabilities. I hit the average here. This is that we're going to go into a recession in the next year, 16%. That's pretty low. The fact that we're in a recession right now, 2%. That's like almost nothing. So, and the market, looking at the charts that I study to see what's the market think about a recession, they're not showing any concerns about that either, at least at this point. All right, and then tech earnings, this is where the real strength comes from, and that's why that's the area that a lot of people want to be in. And then crypto lending here has really shot up as well. We're seeing some kind of Bitcoin's not doing all that well these days. It may have bounced up a little bit here, but it's been kind of breaking through some support. It's back to it's above 100,000, I believe, but it's kind of dangling around that level right now. All right. And then this is looking at before the fall that we had 65.4% of the stocks were positive in 2025. The market hasn't been able to hit that level since then. We were seeing more broad participation before the big downturn last spring. Currently, half of the constituents still in the green despite the index being less than 2% from an all-time high. And these are the big stocks that are really driving things. That's why a lot of folks favor them. That's why you hear about them. That's why I actually show charts of most of these stocks as well. And AI projections all up and to the right. Just that's where things are at right now. All right, here is the chart where we kind of had a flat open here. It looks like we were going to go down, but then we quickly saw some buying coming in, which took us back above the unchanged level, the daily pivot, kind of danced around here for a while. We broke above R1, and then we just kind of stalled at about the 68.25 level and danced sideways. Looked like, okay, maybe we'll be able to hold on to some of these gains. But then you see each one of these bars is 10 minutes. So 10, 20, 30, 40 minutes left to go in the day. We just saw a real tapering off, which gave up a lot of the gains that we had earlier in the session. And not much of a change in the initial overnight session now. And we're seeing still, we're back to the point where we're seeing most of the movement actually coming while the market is open. Where last week we were seeing gap up, gap down, and most of the gains were coming that way. Now it seems to be happening while the US session is open. All right, and kind of trailing off overall here with our large cap growth to value intraday chart. We were looking a little bit better in the bigger picture. If you go back to the end of August here, we have been going up and to the right for the most part, where we're starting to trail off a little bit now. And seeing some weakness here in the intraday growth to value chart for the S&P, actually dropping down below all of the moving averages. So even though it was an up day, there's still some weakness that's starting to come in here. And so growth and value were pretty much even for the large caps, up less for the mid caps, and up strong, but up less for the small caps. So still seeing a pretty healthy small cap growth to value ratio here, breaking out to a new high that way. But the index is not really following along here all that much. It's been just kind of treading water. Actually saw a bit of a decline with mid cap growth to value, falling below the 50 period moving average with the ratio that we haven't seen in a while. And seeing some weakness here with S&P growth to value. We're actually coming down and testing the 200-day moving average. We've been concerned that we cannot seem to get back above the 50-period moving average. Now we're even starting to drop off a little bit more. So on an up day, you would expect this ratio to go up, not down. Still looking good with this one, though. This is another way of looking at growth to value. We're coming down a little bit, but we're well above the rainbow and still hanging out just a little bit below the 50 period moving average with the discretionary equal weight to staples equal weight ratio. And it's not trending. Here's the short-term chart. The ADX, the black line, continues to go down below the moving average. Red line still above the green line, negative. And also going down in the intermediate term, below the moving average, red line above the green line, still negative there. And we are above average with volume here. We're dropping down just a little bit, but we're still above average overall. And we're still seeing some red areas here. We want to watch this 67.44 level. That would be the gamma flip, where we're still up in the green area, 67.96. So we drop 50 points or so, and that is going to turn things much more negative. Still seeing some overhead resistance at the 68.50 level, which was just about where we were at before we had the decline in Tuesday's session. And that could still act as overhead resistance. So we're still leaning more positive here, but if we see more declines, it could actually turn over more negative according to the gamma exposure chart. And we did get the latest reading from Investors Intelligence. They did drop down. We were well above the 4 level. Now we're coming down to 4. It's still extreme. So we use this as a contrarian indicator, but it's not quite as high as it was in the previous reading. And we ticked down a little bit, and we're still under 20 with the VIX, both with the line chart and bar chart. We're not really sticking much to the seasonality of what the VIX has typically done. and saw a little bit of a pull down here with the VIX of the VIX. The volatility did lessen just slightly. We're right back down to the moving average with the bar chart and the line chart. And not really much of a change, up just a little bit with this fear gauge, and we were down quite a bit here with this other fear gauge. So getting a little bit of a contradiction there. A pullback after we saw a pretty big little spike after the big down day on Tuesday, which is not surprising. Some folks are taking off some hedges there, but we're still going up with the 5-day chart, which tends to be more negative, and we're continuing to go up with the 10-day chart, which also tends to be more negative, especially after getting a very low reading with this. We read this opposite. When we get a low reading here, sometimes that can mark a market top. But not seeing much of a change. We're still below the band here when we look at volatility risk premium. So we're not seeing a lot of fear coming back in according to this. And so we ticked up just a little bit after seeing some declines with the advanced decline line based on price and volume, but still positive in the bigger picture. Ticking up a little bit, but still negative with the advanced decline ratio. And we're below zero here based on price with the advanced decline ratio, where we climbed back slightly above zero based on volume. So that is more of an improvement. And at least with the S&P, we're seeing volume leading price slightly there. And we ticked up, but we're still below zero with the advanced decline oscillator. And we're continuing to drop off here with the 5-day and 10-day chart, even though we saw a little bit of an expansion of the new highs and a bit more of a contraction of the new lows. Not enough yet to really turn the moving averages on the 5 or 10-day charts. And we're negative full out here with the accumulation distribution. We're below the moving average. And we're ticked up, but we're still below the moving average with the shorter term boom indicator. And we're actually turning negative with the Chaikin money flow, and the red line's going down. We haven't seen that negative in a while. It was into August when we had a pretty significant down day. And we're below the midpoint and declining with the Chaikin oscillator. So our three smart money indicators are negative and still positive with the vortex. Green line is above the red line. And we're still below the moving averages here with our advanced decline line studies. Both with the NYC common stock, we saw a little bit of a tick up, but still below the moving average with the S&P, below the moving average with the mid caps and small caps, and we're below zero here. This is broader and longer term with the 5-period moving averages, 5-period moving average of the new highs minus the new lows across the broad market. And that's a little longer term, showing some negative action that's continuing in the market. We ticked up a little bit, but we're still below 50 with those stocks in the S&P above their 20-period moving average. That's shorter term negative. And we're below 50 with the 50-period moving average study, below 50 with the 100-period moving average study, and flat. See, this is holding up fairly well. We're going flat here above 50 with the 200-period moving average study. So notice how we hit this dashed line up here. That's a pivot point, and that's about where we topped out. Now we're coming down to another pivot point for November, and this is acting as support. And I'll show that chart a little bit later on too. It's also posted on the YouTube community tab, and it's daily pivot points that you can follow there. So this support is holding up for the time being. A little bit of an improvement, but still below 50 with the 20, 50, and we're still above 50 with the 200-period moving average study. Still just barely extreme negative here with the Stochk RSI. It's the only thing that's showing any kind of conviction right now, where we're slightly above the midpoint with the Williams percent R and just about at the midpoint with the CCI 14, coming down above the midpoint with the CCI 20, and we're still negative but improving slightly with the force index. And nothing extreme now with the short-term stochastic, intermediate term, short-term stochastic, and the long short-term stochastic. And still looking okay. We're below the 10-period moving average here with the bow tie method, but we're still hanging out above the 20-period moving averages. And seeing a little bit more vulnerability coming into the short-term trend. The blue line and the green line are starting to roll over, but we're still hanging out above the 20-period simple and exponential moving averages, and still more than 10% above the 200-day simple moving average with the S&P, which is positive. But when we start to get too far away from that, that has led to more substantial declines that so far has yet to really develop. And we're just a little bit above the midpoint with the standard deviations channel. Now going over the intermediate term, saw a bit of a bounce here after we were in danger of going negative with the balance of power. So that's a slight improvement. And we're still leaning more negative with the lighter blue bars with the go no go system, still hanging out above the midpoint with the highest high, lowest low value chart. And we're still looking at an uptrend according to Landry Light on day 131 of that. And we're on day 9 of the new uptrend with the proper order. So those uptrends are still intact. And after coming down with Tuesday's decline, the TTM squeeze was looking more negative, turning darker blue. Now it went back up slightly and it's the lighter blue. And so that's actually showing some improvement. And still barely above zero with the ease of movement. Still positive with the Arun. The oscillator is above zero and improved, but still below zero with the S&P McClellan oscillator. So we're continuing to decline with the summation index based on price and volume. Improved, but still below zero with the NYSE McClellan oscillator. So we're continuing to decline based on price and volume for the summation index on the NYSE. Now, this is where we're seeing a little bit of hope. We actually turned up in Tuesday's session, even though there was a decline. We were going up slightly with the swollen trading oscillator. We saw more of an improvement after Wednesday, and now we're starting to tick back up based on volume. So this is another area that's showing some slight improvement. But our momentum oscillators are starting to roll over now. We're coming back down to the moving average with the PMO, where we break it out based on price and volume. We're below the moving average and declining. And we're still below 50 with the PMOs that are rising. We're trying to set some kind of a base here, possibly with the buy signals. We're still continuing to decline with the PMOs that are above zero. But we've gone from negative over to neutral with the Elder's impulse system, and we're still positive with the parabolic SAR system here. That has not seen enough of a decline to turn negative. Now we break through, possibly Wednesday's low, that could end up changing. And we're still looking positive here. We're getting mixed signals here with our oscillators. The slope oscillator is still positive, still above the green line, which is often considered an extreme reading. But we're starting to turn negative with the MACD, which is more short to somewhat intermediate term. So we're going up with the slope. We're going down now with the TSI. So the two short-term oscillators are contradicting each other. But we're seeing more confirmation here with a rollover with the three intermediate-term oscillators and starting to flatten out, but still hanging on to being positive with the two long-term oscillators. Rolling over a bit, but still positive with the Copic curve, and a little bit of a tick up here, but not quite extreme with the Sean trend meter. Still above 50 with the money flow, still below 50 with the ultimate oscillator, still above the moving average with on balance volume. And we ticked back above 50 slightly with the short-term RSI and ticked up above 50 a little bit with the intermediate-term RSI. Still holding on to the intermediate term trend based on 50 periods. The blue line and the red line, they're coming together, but they haven't started to roll over yet, even though we've spent a couple of days below the lines. And we're still hanging out from a moving average perspective to things being positive. We'll really be watching these 20 period moving averages, or are we going to be able to launch up from here and go higher? Negative though with the bullish percent index. This is more weakness. Now we ticked up a bit here, but not enough to cross back above the moving average, and it's still below 50. So not much of a change, but a slight bounce with the NYSE bullish percent index, but we're still declining with the NASDAQ 100 bullish percent index. Still working off of a reversal signal, which would mean a down move that the mass index is trying to predict here, but we're still working off of a buy signal with the praying bottom fisher. Go figure. And still hanging out around the support levels here with the mini rainbow when we look at the 20 period simple moving average of the open, high, low, and close. And looking okay from the weekly perspective here. These are weekly bars, even though we're down so far on the week, 0.64%. We haven't really broken the integrity yet of what has been developing since last spring. So looking a little more negative here with the Heiken Ashi with black candles. We're positive but pointing down with the Kigi chart. Still positive with the Renko chart and still positive with the three-line break. So two that are positive, two that are negative. That's a mixed up market that's not trending right now. And still hanging out okay. Not much of a change here with the 150 and 200 period moving average study. Back to just negative in the short term with the mid caps where we saw a bit of a bounce with the small caps. And still negative in the short term with bonds based on price. And we are seeing some strength in the dollar in both the short and intermediate term. And so the only areas that ended up being negative were real estate and staples. And those are defensive areas. So, and even they weren't down all that much. But discretionary, that had a pretty good day. Communication, even though a lot of these sectors gave back a considerable amount of their gains, it did end up closing positive. And tech was up slightly as well. And so we saw negative things right off the bat. You can see over the timestamp right over on the right. This is right after the market opens, where the MACD, or excuse me, the Nasdaq had a bearish MACD crossover, as did the Dow. And then the Nasdaq fell below 23.3, but then got it back above 23.4, 23.5, 23.6. And this is as the day was unfolding. Canada got back above 30,000. S&P for a while was above 6,800, even though it closed below it. And we saw materials have a BPI cross below 30. That area's been getting hit hard lately. Discretionary also had a BPI cross below 30. That's turning more negative. Energy had a BPI cross back above 50. And then oil actually spent some time below 60. So you see, Nvidia was down, Apple was virtually unchanged, Microsoft was down. That hurt the tech sector there. Both Google stocks ended up being positive, as was Meta, so that helped communication. And discretionary, Amazon was up slightly. Tesla had a pretty good day, but it's still pretty much range bound. So the Dow still holding out above this pivot point and in a longer term uptrend and going from negative to neutral with the diamonds with the Elder's Impulse system, still holding out above this pivot point with the Nasdaq. And we're watching this on the S&P. We're also watching it here on the Nasdaq. We'll be watching all of these. Sometimes we can get support from other indexes or resistance as well, but this is hanging on to that support for right now. We've gone from negative over to neutral with the Nasdaq, and we're still holding out above the pivot point with the Nasdaq 100, also switching over to neutral. But we're starting to turn negative with the momentum of the Nasdaq 100. The PPO is rolling over below its moving average. And we did see a bounce, but we're just kind of coming back to where we've been already with the S&P 600 small caps. Now, after falling below the 50-period moving average after Tuesday, we were able to reclaim that with the Russell 2000 small caps. So that is an improvement there. But you look at the bars coming down here, we're still seeing lower highs and lower lows for the most part. So it's not a great looking chart pattern in the shorter term. And we are back to neutral with the small caps with the Elder's Impulse system. Mid caps still under their 50-period moving average and going from negative back to neutral with the Elder's Impulse system. And just looking at the Wilshire, still hanging out above its 50-day moving average, as is the total U.S. stock ETF. Financial sector was up 1/3%, but still below its 50-day moving average. Seeing a little bit more of a bounce here with the ratio between the financial sector and the S&P, but it's got a lot of making up to do to turn this back more positive. The FANG index still holding out above its 50-period moving average. So Apple was virtually unchanged, but slightly positive. We had Amazon up about 1/3%. Microsoft still dealing with being below its 50-period moving average. And Google was up 2.44%. That showed some good strength there. And Meta still having a difficult time getting back up to its 200-day moving average. Nvidia was down, but still well above its 50-day moving average. And Tesla up over 4%, but still, as I said earlier, just kind of going to where prices already been before, and still below the 200-day moving average with Netflix, even though it was up 0.5%. And this really shot up because semiconductors did okay. They did better than tech. So we're still seeing the semis to tech ratio go up, and that's positive and bigger picture positive. And still coming down after hitting resistance with the gold to S&P ratio. And still not seeing much of a change. A little drop off here in the short term, hanging on to the longer term correlation with the US versus world stocks. And dropping below 60 now with oil. And the dollar crossing above 100, not much above 100, but if we start to see some more strength here, as I've been saying, this could put some pressure on stocks. And here's another chart here. It says the dollar technicals based on our technical indicators. The bounce in the dollar could have further to run. We were getting really extreme negative here, and now it's continuing to go up, which could end up being negative for stocks. Stocks like a weaker dollar because of the conversion rates and the import export relationships there. And then we are still climbing up above this 4% level. with the 10-year yield. That's the Fed comes in and cuts rates, and the 10-year yield goes back up and starting to fall below the 50-day moving average with the 10-year based on price. And still looking okay here with the Qs to S&P starting to climb above the moving average with discretionary to the S&P declining, but still above an advancing moving average when we compare large cap growth to value. So large caps still above the moving average, still below the moving average of the mid caps, and still seeing some strength here with the small cap growth to value ratio. And here is the latest from the Hindenburg Omen. No new spike, but we did get a confirmation on October 10th. We had the initial spike. We've had a couple of spikes since then. The more spikes that we get here, the more we should probably pay attention to this because if you see, this was telling us before the whole COVID crash and also at the end of 2021, before we went into the bear market of 2022. So we want to at least respect this for what's happening here. All right, so we're still positive on all the time frames. Now we're supposed to get it initial and continuing claims. We're probably not going to get those because of the government shutdown, productivity and unit labor costs, wholesale inventories. In your dreams here, people. Not going to get anything with the government shutdown because it's still going on. And then geopolitical things. Of course, the election, that's kind of what the pop news is right now in the US, but there's all kinds of really crazy things going on. There's some Supreme Court decisions that could be breaking at any time that may have a massive impact, that may end up having an impact on the stock market and what is the president's power as far as tariffs are concerned. And then this is supposed to be the economic calendar, but and then here's another one. And it's like, okay, I went back to look at this calendar again, and now it has no events scheduled here. So don't anticipate any economic releases that way. Now we are positive from a seasonal perspective for November 6th for the Dow, S&P, and Nasdaq. So we got that going for us, and we are still dealing with a period of positive seasonality during a post-election year for the beginning of November. And November is one of the stronger periods of the entire year for the market. And this also shows the continuation of positive seasonality. Doesn't mean that's going to happen. It's just what has happened in the past. And this is how things tend to react. We tend to go a little bit sideways here after the Fed cuts rates, and then typically we'll end up going higher. That's when we just go back to 2008. This also shows positive seasonality into the end of the year. This also shows the positive seasonality, and this also shows the positive seasonality. Okay, yeah. And then we're dropping off here. We're way beyond the bell part of the curve here when we look at the blackout period for when companies can make announcements that they're going to do buybacks. Still there, but not as intense as it was before. Now we go through our three smart money indicators. They're not looking all that good right now. Even with the up day on Wednesday, they're not really improving. They're turning more negative. And we are negative with the S&P and NYSE McClellan oscillator and summation indexes. The ultimate oscillator is below 50. The bullish percent index, it bounced, but it's not above its moving average. So it's still negative, and the momentum for the NASDAQ 100 is turning negative. And we do have this confirmed Hindenburg Omen that we're just kind of keeping an eye on. And the mass index is signaling that we may get a reversal. And then the parabolic SAR is still positive. Now we're still leaning more positive with our momentum oscillators, but they are weakening. And if we don't see some strength pretty soon, they're probably going to roll over and actually start turning negative. And then, as I keep saying over and over here, longer term, the growth to value and discretionary to staples ratios, they're in uptrends, but we're not seeing a lot of conviction and strength in the shorter term. And we haven't seen that now for a while. Even to have an update on Wednesday like we had and to see the S&P growth to value ratio, now it's testing its 200-day moving average. And then the swollen trading oscillator is positive. That's one of the bright spots that we're picking up right now. Now, the bullish percent index for the NASDAQ 100 and NYSE, they're declining, but I have them positive because they're above 50. These of movement is just barely positive, as is the money flow, the vortex. Financial sector is still in an uptrend, and it did improve, but it has a lot of improving yet to go if it's going to turn back and start outperforming the S&P. And then our long-term special K chart is still positive. And then this is what I wanted to show. And I post this on the YouTube community tab. You notice how this pivot point, this has been acting as support for the last couple of days. You'll probably want to watch that level. Now, that's a little different pivot point than what we've been watching. This is a Fibonacci pivot point. And so keep an eye on this and see if it ends up being something. It's been something over the last couple of days. So we'll want to see if it continues to provide support. If we start to break below that, that could turn things more negative. And then here are the intraday pivot points for Thursday's session. So our conclusion, not an awful lot of changes here. We're still positive when we base things around moving averages. The 20 period moving averages are holding right now. We're still seeing a little bit more of a lean towards negative momentum, and we're not trending. Also, some weakness is developing in the intermediate term, but we're still positive since we're above the 50 period moving average. But we're not trending there either. We're still positive, but more than 10% above the 200-day simple moving average. Thank you. I hope you have a wonderful day, and I will talk to you in the next video.